The scariest number in retirement is not how much you saved, it is the order your returns arrive in. Let me show you what I mean. Two real men, real figures. Picture two guys, Gary and Dale. Each man retires in January of 2000 at age 65. Both start with $1 million in an S&P 500 index fund. In year one, each plans to live on 4% of it. That comes to $40,000. That 4% figure is famous. It is the rule of thumb every retirement article has pushed for 30 years. People call it the safe withdrawal rate. Each man also gives himself a small raise every year, about 3%, so his spending keeps pace with prices. So far, everything is a perfect match. 25 years later, here is where they landed. One of them died with more than $3.5 million in the bank. The other went broke while he was still alive. Same returns for both men. The only thing that differed was the order those returns came in. I am going to walk you through the exact math. Once you see it, you will plan your whole retirement differently. I want to be scrupulously fair here, so I change exactly one thing and hold everything else identical. Change that one variable, watch the outcome split, and you have found the cause. No hand waving, no cherry picking. But before I let either man spend a dime, watch this. First, I run a control. Both portfolios ride for 25 years. They earn the real S&P 500 returns from 2000 through 2024, and neither man withdraws a single dollar. No spending at all. Gary gets the returns in the order history actually delivered them. Dale gets those same 25 returns in reverse. Then I check each man's ending balance. They end up identical. To the penny. Both finish with $6,386,000. Not close. Identical. And that makes complete sense. When all you do is multiply, the order does not matter. 2 times 3 times 4 equals 4 times 3 times 2. If nobody pulls money out, the sequence of your returns is irrelevant. Hold on to that fact. It is about to matter enormously. Now I turn on the spending. Same $40,000 a year rising with inflation for both. Nothing else changes. Only the order of the returns is different. Gary lived through the real order, and the real order was cruel. The market fell in 2000. It fell again in 2001. Then it fell a third straight year in 2002. 3 losing years right out of the gate. Then 2008 came and knocked off another 37%. So Gary spent his first decade watching his savings bleed. All the while, he kept pulling out his grocery money every month. Picture it. He starts at $1 million and takes his $40,000. The market knocks him down again. He ends year one under $900,000. He does the same thing the next year and the next. By the bottom of the dot-com crash, he is near $500,000, and he has barely started retirement. The hole got dug early. He never climbed out of it. Gary ran out. Flat broke, $0 in his late 80s, still very much alive. Dale got those same returns backward. Same numbers, kinder order. His strong years came first. His crashes landed at the end after decades of growth had stacked up. Dale never came within a mile of running out. He died with more than $3.5 million still invested. His kids inherited it. Look at what just happened. Everything about these two men was identical except the order. Each one grew his money at the very same rate, right around 7.7% a year compounded. That is a perfectly ordinary quarter century for stocks. One honest note on my test. I put both men entirely in stocks on purpose to keep it clean. That way only the order could move the result. A real retiree usually holds some bonds too, which softens the early blow. But do not take too much comfort there. Even a normal stock and bond mix gets badly stressed by this exact sequence. One man died with millions to spare. The other died broke. The only difference was which end of the returns came first. And notice the quiet villain here. The 4% rule told Gary to raise his spending every single year. It told him to spend more in 2003 than in 2002, right after his savings had been cut nearly in half. The rule never once looked at his balance. It just marched his spending upward while the floor fell out below him. By 2003, it had him pulling out almost $44,000 from a pot near $500,000. That is a rate above 8% on autopilot at the worst possible moment. So why does spending flip the order from harmless to deadly? Here is the mechanism. It is simple once you see it. The market crashes. You still need to eat, so you sell shares to raise cash. Selling into a crash means selling cheap. And here is the part almost everybody misses. Those shares are gone. They are not waiting in your account to bounce back later. You already spent them on groceries, so when the rebound finally comes, it lifts a smaller pile. You sold off the very shares that were supposed to ride that recovery back up. I think about it like a cattle farmer. Say a brutal winter hits in your first year on the land. To survive it, you sell off your breeding cows. You make it through the cold barely, but now spring arrives. You have nothing left to rebuild the herd. You already sold the animals that make next year's calves. Now picture a second farmer. His first winter was mild. He kept his breeding stock. His herd grew for years. By the time a hard winter finally hit, he had a big herd that could absorb the loss. Same farm, same lifetime of weather. The man who caught the storm early never recovered. That is Gary. The early crashes forced him to sell his breeding stock at the worst moment. Nothing was left to grow back. This has a name. The financial world calls it sequence of returns risk. Once you live off your money, the order of your good and bad years matters as much as the average. And here's the cruel twist. You did not get to choose your order. Gary did nothing foolish. He did not panic. He never chased a hot stock. And he followed the 4% rule to the letter. His only real mistake was retiring right before a bad stretch. A bad stretch almost always looks calm on the way in. One more thing about when this risk bites hardest. It is concentrated in a narrow window. That window is the handful of years right around the day you stop working. A crash in that window does the most damage. Your portfolio is at its biggest and you have just started drawing it down. The same crash 20 years later barely leaves a mark. Those few years around your retirement date are the fragile ones. They deserve the most care. Quick pause. Because this is who I am. I am Tom. This channel is about real personal finance. The kind that works for regular people, not the kind that sells you a dream on a thumbnail. You will get no motivational fluff from me. You will get no fantasy returns either. Just what the math actually does over a real lifetime with real figures like these. I am an ordinary guy who reached financial independence on an ordinary income. I got there mostly by understanding things like this before they could hurt me. If that sounds useful, hit subscribe. It helps more than you would think, so the natural question is the scary one. You cannot control the order. The order can bankrupt you. Are you just gambling your retirement on your quit date? No, you are not. The order is only half the story. The other half is how you respond to it. And that half is entirely in your hands. Here's what I most want you to walk away with. The people who almost never run out are not the ones with the biggest pile. They are the ones who stay flexible. Let me hand you 3 tools, then I will prove the main one on Gary himself. The first tool is simple. Do not be a forced seller. Keep a year or 2 of spending money in cash and short-term bonds. Park it quietly outside the stock market. When a crash hits, you live off that cushion. You do not sell your stocks at fire sale prices. You give the market time to recover before you touch your shares. That cushion is the difference between panic selling your cows and waiting out the winter in the barn. 2 to 3 years is what most people aim for. That covers the short, sharp drops. The market cratered in early 2020 and was back at new highs within months. A cushion like that carries you across the ordinary gaps without selling low. It will not outlast a long, grinding bear like the one Gary hit. That is exactly why it is only the first of 3 tools, not the whole answer. The second tool is the big one. It has a name worth knowing. It is called the guardrails method. A financial planner named Jonathan Guyton and a professor named William Klinger worked it out. The idea is beautifully plain. You set 2 lines around your spending, an upper one and a lower one. Say the market falls hard. Your withdrawals start eating too big a slice of a shrinking pot. You cross a line. That line tells you to trim your spending for a while. Now say the market soars instead. Your portfolio balloons. You cross the other line and you hand yourself a raise. Here is the plain version of the 2 lines. Pick your starting rate. Set a trim line about 20% above it and a raise line about 20% below. Push past the trim line in a downturn and you cut your spending 10%. Sail past the raise line in a boom and you add 10%. The lines do the thinking, so panic never has to. Think of the cruise control in your car. It eases off the gas when the road tips downhill. Your spending flexes with reality instead of ignoring it. Now let me prove it works. I took Gary, the man who went broke. I ran him through the exact same nightmare again. Same retirement in 2000. The same crashes in the same brutal order. He still starts at 4%. The only change is that Gary now uses guardrails. He trims when the market tells him to. He relaxes when the market says he can. Gary never runs out, not even close. Instead of dying broke, he dies with about $2.3 million still invested. Same crashes, same terrible order. This time he bent instead of snapping. And in the good years later on, the guardrails let him spend more than his original $40,000. The raise rule kicked in once his portfolio recovered. He got the best of both. He protected himself in the lean years and rewarded himself in the fat ones. But I promised you real figures. So here's the catch. Told straight, guardrails only work if you actually cut when the line says cut. In Gary's worst years, his spending fell from $40,000 down to about $26,600. That is a real drop. He felt every dollar of it. Fewer trips, less eating out through the lean stretch. That is the trade guardrails ask of you. Anybody who promises you a magic rule with no changes at all is selling you fantasy returns. You need to understand why that cut has to be real. The market never hands you a smooth ride. It handed us a loss of 18% in 2022, then it handed us a gain of 25% in 2024, one right on the heels of the other. That jagged back and forth is the real texture of investing. And prices keep climbing every year on top of it. So the raise you skip in a bad year is really a quiet pay cut. Each of your dollars buys a little less than before. A plan that cannot survive the down years and rising prices is not a plan. It is a wish with a spreadsheet attached. The third tool is the deepest protection of all. It changes how a crash even feels. Build a floor under your essentials. Think rent or mortgage, food, the utility bills, the stuff you cannot skip in a down month. Cover those with income that cannot crash. That means Social Security, a pension, or an annuity you buy on purpose. The average Social Security check for a retired worker in 2026 runs just over $2,000 a month. It never has a bad year in the stock market. No pension? You can build your own. You hand an insurance company a lump sum, and they send you a monthly check for life. That is all an annuity really is. Once your basics are covered by money that cannot fall, your portfolio only funds the extras. So when the market drops, you cut the vacation, not the rent. That is a completely different feeling. Put a number on it. Say your essentials run $3,000 a month. Social Security covers $2,000 of that. Now your portfolio only has to make up $1,000 a month. Only that $1,000 is exposed to the market at all. Shrink what the market can touch, and you shrink your odds of ever running out. I have a neighbor named Paul who lives exactly this way. He retired years ago on a solid pension plus his savings. He keeps his spending flexible on top of that base. The market fell hard in 2022. Paul did not lose a single night of sleep. His pension covered the essentials no matter what. His cushion covered the near term. He simply skipped a couple of trips that year. The crash was a headline to Paul, not a crisis. That calm is what a floor buys you. So let me pull the whole picture together. It is far more hopeful than the Gary story sounded at the start. The retiree who almost never runs out did not guess the biggest number. He built a plan that bends. There is a floor under the essentials, so a crash cannot reach the rent. A cushion of cash sits behind it, so he is never a forced seller, and his spending breathes with the market through guardrails. He trims in lean years and loosens up in fat ones. Notice something. Not one of those three things requires a fatter portfolio. They require a smarter structure. Gary did not need more money. He needed permission to bend. Build these in order, by the way. The floor goes first because it guards what keeps you alive. The cushion goes second. Guardrails come last once the first two are set. And here's how badly rigidity can cost you. Gary tried to live on 4% and still went broke. Say he had tried to live a little larger on 5%. That same brutal order would have wiped him out by age 80. That is roughly 8 years sooner. The stiffer the plan, the faster the sequence killed it. Here is your one job this week. Split your retirement spending into two lists. The first list is the essentials, the bills you truly cannot skip. The second list is the flexible stuff. Travel, dining out, the nice to haves. That line between the two lists is your entire safety margin. The bigger your flexible list, the more room you have to bend. You can ride out a bad year without ever touching what matters. Say your essentials were fully covered by Social Security and a pension. You would already be most of the way to a retirement that almost never fails. Tell me in the comments where your line falls. I read them, and it tells me what to dig into next. Running out of money is almost never about the size of the pile. It is about being rigid at the exact moment the market demanded you bend. Gary and Dale had the identical pile and the identical average. One of them just needed the freedom to spend a little less in the scary years. That small freedom would have been worth more than $3.5 million. Build the floor first. Keep a cushion behind it, then let your spending breathe with the market instead of fighting it. Do those things, and the order of the market stops being a threat that can bankrupt you. It becomes just whether you planned around. If this helped you see your own plan more clearly, go ahead and subscribe so the next one finds you.